Hi, and welcome to the Data Explorers Securities Lending Update for November 25th, 2008. I'm Mike Galvin from the New York office of Data Explorers. This Friday in the U.S. is known as Black Friday, which marks the unofficial start of the upcoming holiday shopping season. Most of the time, this is the day that puts retailers in the black for the upcoming Christmas period. With this week's Black Friday shaping up to be more of a Red Friday, we've decided to focus on the retail sector for this week's updates. At the moment, the North American retail sector has the highest level of short interest, as evidenced by the average amount of supply on loan. Putting that into context, U.S. retail has about 27% of supply on loan, compared to autos at 24%, software at 19%, media at 20%, and financials at 18%. Taking a look at some individual names, Target has seen their utilization, or the percent of stock on loan relative to supply, increase by about 50%, and the percent of shares on loan outstanding increased about a third since September, during which time the stock price of Target has also been cut in half. Their recent earnings disappointment of 24% decline is a fifth consecutive drop in quarterly profit. Adding insult to injury, they've also reported that same-store sales are down, they're scaling back new store openings, and they're postponing an intended share buyback. They've been struggling recently, as about 40% of all of their sales are on such discretionary purposes as their trendy but cheap clothing, furniture, etc. In today's current economic environment, consumers have been drastically scaling back such discretionary purchases. In contrast, Target's main competitor, Walmart, has been able to weather the current economic crisis a little better, focusing more on consumer staples and necessities. Their 4% increase in same-store sales and 10% increase in Q3 profit are also reflected in their low utilization and percent shares outstanding on loan. Walmart's 5.7% utilization is almost 4 times smaller than Target's, and their 1% shares outstanding on loan is about 5 times smaller than Target's. Walmart recently announced they've experienced a 2% increase in households earning over $65,000 per year, most likely that coming from former or at least more infrequent Target shoppers. High-end retail, Nordstrom has seen their percent shares outstanding on loan increase by about 27% over the past week, as they've announced disappointing same-store sales of an 11% decline. Moody's also recently lowered their outlook on Nordstrom from stable to negative. Large U.S. retailer Sears has seen utilization levels over 80% for the past 6 months, currently the second highest short in the S&P 500. And it's also been in the top shorts of the S&P for the past several months. Now, it's not all doom and gloom in the retail sector, as similar to Walmart, other retailers focusing more on consumer durables and staples have fared pretty well comparatively. Currently, less than 1% of Colgate shares outstanding are on loan, and less than 2% of supply from institutions are on loan. Such firms as Walmart and Colgate have had success due to their relatively inelastic demand for their products. With today's Securities Lending Update, I'm Mike Galvin.